Hello, thank you for joining for my presentation. I will talk about the project on valuation under the Proof-of-Stake Protocol. Let's start with the scope of the problem that we cover here. Our objective is to develop a valuation framework for payment tokens, not the utility tokens, payment tokens. And we will be focused on the valuation problem and related economic problems. We're going to abstract from the issues of incentives and whether or not the protocol itself is going to work as designed. So we're going to assume that the blockchain operates as intended. At the end of the day, these two problems, incentives and valuation of tokens, of course, are connected. It's just that our focus in this project is on the valuation problem itself. Now, let me give a quick overview of the essential elements of the proof-of-stake protocol that we're going to model here. I'm sure that many of you are very familiar with these, but just so that we're on the same page, we develop a valuation model for the proof-of-stake payment systems. And this model is going to apply to the delegated proof-of-stake as well. We have several applications. I will cover just some of them in this presentation. We'll apply our results to network security, to analyzing valuation bubbles, to monetary policy, in particular active monetary policy, and also payment channel networks. Now, it's important that under the proof-of-stake protocol, the valuation problem and network security are connected. And this is quite different from the proof of work, where security comes from the physical costs of mining and specialized hardware. Here, network security is connected to valuation. In that sense, this valuation problem is particularly important. I will also say that our valuation model is conventional by finance standards, in a sense that it relies on the contingent claims valuation methods with some features that are specific to this setting. So those of you coming from finance background are going to see that this is very familiar and very much resembles contingent claims valuation. Now, if you compare proof of work with proof of stake, just to connect to other aspects, other elements of the space, Bitcoin, of course, is the dominant example of the proof of work protocol. Arguably, proof of work wastes a lot of energy. This is not fully settled, but there is a strong sense that one can do better. One can have a more efficient system, and the proof of stake offers such a promise of an alternative design that's more energy efficient. There are a number of systems nowadays that are either operational or under development using various versions of this proof-of-stake idea with about $15 billion in tokens across these proof-of-stake and delegated proof-of-stake systems. And Ethereum in particular is a very big player in the space that is kind of planning transition to proof-of-stake down the road. So it's an important part of the ecosystem, and hopefully our valuation framework can be used to shed some light on its properties. Now, let me describe a few elements of the proof-of-stake protocol that we're capturing in our model. So this is a stylized description, not going into the technical details. It's an abstraction. So we have several key elements of the system. We have block proposers who form blocks. Blocks are being finalized. And there are incentives that the system provides in the form of slashing as a punishment for misbehavior. Block proposers are elected using a decentralized randomization algorithm. And the probability of being elected as a proposer is a function of how many tokens the individual participant holds. The elected proposers form blocks, and they pack these blocks with transactions, and they collect some rewards for creating these blocks. These blocks would eventually be added to the chain. Now, finalization is an important step in the protocol where blocks are periodically finalized. So essentially, they're permanently added to the chain. And there are various versions of this architecture one could imagine, but essentially what this picture highlights is the possibility that at some point, there are potential conflicting versions of the chain, and during the finalization step, the so-called validators, these are participants who are willing to stake their tokens to gain the right to vote in this protocol. They choose one of the two possible versions here, and that becomes the official version of the chain. So for example, you go for the block number 50, add it to 49, block 50 prime is discarded, and then those transactions go back to the mempool, and they could get added in the following blocks, but not for the time being. Now, what is critical here is that validators have to stake tokens, hence proof of stake, and they collect rewards for this activity. Rewards that they collect are pro rata, they're in proportion to the number of tokens that they stake, and they expose themselves to the possible punishment or slashing if they misbehave. So what we're going to assume is that in equilibrium, validators do not deviate from the protocol, so the incentives work as designed and they don't make mistakes. So nobody gets slashed, there is no loss of tokens in equilibrium. This is an off-equilibrium threat, slashing. What is critical about equilibrium is that validators collect rewards in proportion to the number of tokens that they stake. This is going to be at the center of our valuation model. So let me show you a simple version of the valuation model. This is a constant growth model. We're going to abstract from the distinction between proposers and validators. In principle, you could model them as two different classes of participants or market participants here. We're going to merge them into a single pool. We'll call it validation pool. What's important about this validation pool is that it collects rewards. For the next few minutes, we're going to assume that the only rewards come in the form of transaction fees. So there are no rewards from new tokens that are assigned to the validators. We will add that feature later. There is no inflation, quote unquote inflation in the system. All of the rewards come from the transaction fees that are attached to the transactions that enter the blocks. We assume that validators behave competitively, means that they take prices as given, and they also take network design as given. They're not trying to change the protocol. And again, importantly, validators have unrestricted access to a complete financial market. It means that they can trade in all sorts of financial securities. Any stream of cash flows you could imagine can be priced in this environment. And the result is that network participants here are going to value different streams of cash flows, which we'll discuss, in relation to their opportunities in the financial market. So they're going to compare these tokens to stocks, bonds, and other financial securities that are out there, as well as other digital securities. So we're going to assume that there is the stochastic process of transactions that this network executes. We can call them payments, measured in dollars and fiat currency. The total amount of transactions per period is Y sub t. We will aggregate total supply of tokens and normalize it to 1. So there is always one token outstanding. And P is the equilibrium price of this token. So this is the total price of all the tokens in the system. Now, we are going to use a risk-neutral valuation approach. For those of you who are not in finance, this is a mathematical trick which transforms the problem and allows us to compute valid prices by discounting expected cash flows at the risk-free rate. The only twist is that these expectations are not under the actual probabilities, but under distorted probabilities or risk-adjusted probabilities. And so we're going to use this so-called martingale pricing measure or Q measure or risk-neutral measure to discount cash flows. So we will assume that all the expectations here are under the martingale pricing measure, and under that measure, the total volume of transactions is expected to grow at a constant rate, G sub Y. This is the risk-neutral or risk-adjusted growth rate of transactions. We also assume that the total amount of fees that transactions generate is proportional to the total volume of transactions. It's important that this doesn't mean that for each transaction, fees are proportional to the economic value of the transaction. That might not be the case at all. But in the aggregate, transaction fees and transaction volume are proportional to each other. We can relax that and just make them co-integrated, but what's important is that they're growing in the long run at the same rate. In the simple kind of version of the model, constant growth model. Now, validators collect rewards in proportion to their individual stake. And we assume that they follow the protocol, so there are no games that they play, there's no selfish mining, nothing like that. So they really get the fees in proportion to their stake. And the interest rate for simplicity is a constant. Interest rate here is the rate of interest you would get in the financial market. So if you invest in treasury securities, that's the rate of return. Now we look for a stationary equilibrium in which the total fraction of tokens held in the validation pool is a constant. Over time, we call that fraction phi, which means that the total market value of the validation pool is phi times p. That means that it's the fraction of the total value of tokens in the system. And of course, this value has to be equal to the market value of a claim on the stream of cash flows equal to the transaction fees. That's what the validation pool collects. Collectively, all the validators collect all of the fees. Now, in equilibrium, validators have to earn their opportunity cost. The rate of return that they're earning here has to be consistent with the rate of return on an investment with the same risk profile in the financial markets. Our risk-neutral pricing measure, the Q measure, takes that into account. And so what we find is that the total value of the validation pool, which is P, the total value of tokens, times phi, the relative size of the pool, is equal to the expected discounted value of the future fees, and that is equal to the current flow of fees, C times Y, divided by interest rate minus the risk-adjusted growth rate of transaction volume in the system. So again, those of you coming from finance, you see this is the Gordon growth model applied in this context. So far, we computed the value of the validation pool, not the total value of tokens. The validation pool is a fraction of the total value, so it's a lower bound on the value of tokens. But to get to the exact value, we need another condition. This other condition is going to come from the assumption on the behavior of consumers. If the only people holding tokens in the system are validators, then phi is equal to 1, and what we found is the value of tokens. If there are other participants, let's call them users of the system who are not validators, holding balances for convenience reasons, we are going to model that in a traditional monetary economics way. We'll just assume exogenously that the balances that consumers hold are proportional to the volume of transactions. It's the simplest model, of course, not the most realistic model, but it's the simplest model of balances. So we're going to say that the balances that consumers hold are K times the transaction volume. You could think of K as the inverse of the velocity of money in this environment, or velocity of tokens. This tells us that the value of all the other tokens outside of the validation pool, which is P times 1 minus phi, is equal to K times Y. So that is going to be the total value of balances that the users hold. That's the second equation. We can combine it with the previous equation we derived and compute the value of all of the tokens. And that is the equation you can see here. So what this is telling us is that the value of the tokens is proportional to the volume of transactions. It takes into account the rate at which fees are collected, C. It also takes into account the inverse velocity of tokens. Now, let me comment on the role of velocity here. In the context of proof of work, many of the proposed valuation models rely on velocity of money arguments, quantity theory of money, which basically says that if you know the velocity of money, you know the volume of transactions, you can recover the value of the total stock of money. Of course, we don't know the velocity of transactions. That's the bottleneck. And this approach has the downside that if you let velocity of transactions go to infinity, then the value of tokens converges to 0. That's not the case in our setting. Even if you let velocity of money go to infinity, in which case K, the inverse velocity, becomes 0, that means that consumers don't hold balances. They transact so quickly that they acquire tokens and get rid of them instantaneously. Even in that limit, the value of tokens is not 0. It's equal to the value of the validation pool, and validation pool is 100% of the total. Of course, to make this a more realistic description, we would need to endogenize the token velocity, which is outside of this model. That would require a behavioral model of how and why consumers hold balances. Now, conceptually, tokens in this environment have value because they serve as collateral. If you want to earn transaction fees as a validator, you need to post collateral, a stake. And the only accepted form of collateral by assumption is tokens. That is what gives tokens value. Of course, one could ask, how come you cannot use another form of collateral? You could change the design, accept other forms of collateral. Wouldn't that undermine the value of the tokens? Wouldn't that create substitutes? Answer is yes. If you could imagine using other assets as collateral, such as treasury bills, that would reduce the value of tokens. Now, of course, using other assets as collateral is not free. First of all, integrating these external assets into the system is against the ethos of the whole enterprise. They don't want to use these external assets. It's not going to be trivial. You're going to need intermediaries to help you execute, because now these assets don't exist on the system, they're external. So you're going to need custody, and you're going to need clearing for these transactions. So that sort of becomes self-defeating. Also, many users, they may not have access to good collateral like this. That's another issue for designing these types of systems. Now, you could potentially use digital assets as collateral. You could create protocols for integrating multiple systems together. It may not be easy to execute, but it's possible. Conceptually, in this case, you could think of our valuation framework as describing the value of an integrated collection of systems that accept tokens across this collection as valid collateral. But that's a digression. For the simplest model, you could think of a single payment system, and the only acceptable collateral for stakes are the tokens from the system itself. Now, I already mentioned the role of velocity. Now let's talk about what happens when there is increasing token supply in this environment. Suppose that in addition to collecting fees from transactions, validators are rewarded with newly minted tokens. So they're rewarded for their activity, again, in proportion to the size of their stake. These tokens are generated algorithmically according to the hardwired monetary policy, whatever is assumed by the protocol. But what's important is that users of the system who are not validators do not collect these new tokens. All of the new tokens go to the validators. In this case, we can extend our model. Again, the total value of the tokens, P, is equal to the balances held by consumers, K times Y, plus the value of the validation pool. That is the market clearing condition that's still valid. And as before, validators have to earn their opportunity cost. Under the Q measure, the expected return on their balances is equal to the interest rate. The only difference now is that in addition to collecting fees from transactions, they also collect what we call inflation tax. They benefit from inflation tax because other users of the system see dilution of their holdings, and all of the newly minted tokens go to the validators. This is economically similar to the signage that the government generates by printing money. So this is the analogy, but we'll call it inflation tax in this environment, and we can quantify its effect. If you go through all of the previous steps, you arrive at a new formula, which tells you that the ratio of the price of the tokens to the total volume of transactions is, again, inverse velocity of tokens, plus the term that discounts fees and cash flows from future transactions, except now, in addition to the transaction fees, there is also inflation tax collected by the validators. This inflation tax is a product of two terms: the size of the balances that consumers hold, K, the inverse velocity of money or tokens, and G sub S is the growth rate of the total token supply. So what this is telling you is that the longer consumers hold the token in their wallet before using it, the more they're going to lose to this inflation tax, the more dilution they suffer. And the faster the system prints new tokens, the higher the inflation tax. So it's very intuitive. The inflation tax, of course, also affects the solution for the size of the validator pool fee, because it makes validation activity more appealing. So we see that the size of the validation pool increases with the inflation rate. I'm close to my capital T. I'm almost done. So let me give you a quick numerical example. Let's assume the transaction fee is at the rate of 0.1%. So it's fairly low. Expected growth rate of transactions, this is the physical expected growth rate, is 3%. It's basic rate of GDP interest rate is 1%. These are all real quantities. Real interest rate is 1%. The risk premium attached to the cash flows from fees is 4%, which would be in line with comparable cash flow streams in the financial markets, roughly. The inverse velocity of tokens is 15/365. And the token supply rate is 2%. The bottom line of this example is that depending on the token supply rate, with a 2% rate of inflation, the total value of tokens is close to 11 billion, with $10 billion of transactions per year. And without additional tokens, it's close to 1. So inflation rate plays a critical role in providing value for the tokens in this environment, because a lot of the value from validation activity is coming from inflation tax.